So we're continuing our discussion about market failures. So we've been making a list of market failures, the problems they create, and how we fix them. So we talked about public goods and common goods, negative and positive externalities. The fifth one we want to look at is instability in the market. So we're talking about when we mean instability in the market is business cycles, periods of rapid growth followed by contraction. And this is problematic because this leads to inflation, prices going up if our economy is growing too fast, and unemployment. When the economy contracts, we lay people off, they don't have jobs, they can't spend money. That impacts the economy as well. So let's take a look at what we mean by instability in the market. When we talk about instability in the market, we're talking about our business cycles. So when we look at our GDP, gross domestic product, this is the total value of all final goods and services produced in an economy in a year. So total value of everything we make. And in macroeconomics, you take that course, we'll look at how you calculate gross domestic product, what's in there, and why it's the total value of all those final goods and services. So we're going to look at that total value of everything we make. And we want to take out inflation, so we're going to look at it in real terms. We'll talk about how to do that in macro. How do you take out inflation? So we're going to look at real GDP, and we're going to look at it really per capita. So how much do we produce per person? We take out inflation, and we're really looking at the amount we produce, but we can't just add a truck and a laptop. So we're looking at it in real terms. We're looking at it in dollars, but we're taking out that inflation, that price change. So we're looking at real GDP per capita, the amount we're producing per person, and sometimes the amount we produce goes up. Okay, we call this expansion. Then we hit a peak, and then our economy starts to contract. So we have this period of contraction where we're producing less goods and services per person. Then we hit a trough, and then we start to expand again. So this instability in the market is periods where we're producing more goods and services per person, and then periods where we're producing less goods and services per person. So our business cycle is expansion, peak, contraction, trough. Repeat. Over the long term, when you look at what's happening with that real GDP per capita, the amount we're producing, over the long term, we see economic growth. Okay? So in fact, here's Canada in terms of real GDP back to 1926. And notice, over the long term, we see growth. It's the little up and downs that you see here that indicate to us the business cycle. Right? They don't look so bad when we look at it big picture. Let's zoom in a little bit more. So here's essentially the 70s forward. Again, economic growth. Over time, we're making more and more stuff per person, which is great. Higher standard of living, access to more goods and services. Now, this does not look good. This is COVID-19 in 2020 causing a downturn, a contraction. These little blips, they don't look so bad though. Now, if we take out that long-term trend, we start to get a better picture of the instability in the market. And seem to be having some issues here. Let's see if we can cut and paste it back. Get it to show up. If not, I'll restart. Of course. technical difficulties. Hopefully our graphs will reappear when we restart our program. There we go. So when we take out that long-term growth trend, we start to see the great instability in the market. Okay, so this big dip that you see here, where the economy contracted 15%, that's the Great Depression. Okay, and you can see other periods of time where we've had growth and where we've had contractions. Let's look a little more current here. So we need to define these contractionary periods. This is where we are producing less goods and services. So real GDP per capita is decreasing. Okay. So during this contraction, real GDP, the amount we're producing, is going down. The unemployment rate is going up. Now we can see some of these contractionary periods. We have them about every 7 to 11 years. So you see one in the 80s, the 90s. This is the Great Recession, 2008. This is COVID, causing businesses to be shut down, issues with supply chain, customers not willing to go out and go shopping and travel, causing, again, the amount we produce to be less, the number of layoffs to go up. And so we can see the impact on our economy. So we can see, in fact, that COVID-19 has contracted our economy really about 12-13%, which is really interesting because you go back to that Great Depression and you see that it's about 15%. Now, the Great Depression, so let's define this, because a recession is when you have contraction for 2 quarters or half a year. A depression, like the Great Depression, is where you have that contraction for 2 years. Now, we call this 2008 the Great Recession because this was the closest we got to a depression. The Great Recession was 2008, 2009, but it's not a depression because a depression has to be continual contraction for full 2 years. During that recession in 2008, 2009, contraction, whoop, things got a little better, more contraction. So it wasn't a depression. It was just a bad recession. But if we put it into context with how we did in other recessions, it doesn't seem so bad. And in fact, the term Great Recession is a global term, and that's because the Great Recession was a lot greater for other countries than it was for us. So we didn't have as big of contraction. This is the US. And you can see that Great Recession, they had a much bigger contraction than in previous recessions. Whereas for us, it really wasn't as great. It was a recession, there was contraction, but it wasn't so bad. Now, COVID-19, right? We start to see that a number of businesses and operations closed down starting in March of 2020. There's a lot of disruptions. People aren't buying. This video is made in November of 2020. Okay, so we March to November. We're a couple months in. Now, while this is quite severe in terms of the size of the contraction, you have to be continually contracting for half a year to be in a recession. And often it's going to take us 6 more months after that to even realize we were in a recession because we have to crunch the numbers and compare. So it's possible that COVID-19 could put us in a recession. It is unlikely that it's going to cause a depression. Remember, continual contraction for 2 years straight. And while there is a lot less production happening, a lot less buying happening, people being laid off because businesses aren't operating, as soon as the issue can be resolved, whether that's with a vaccine, then we expect a lot of buying, a lot of people to be back. And so then that contraction becomes expansion, right? So the business cycle, if we go back, I guess we restarted our program, so let's just draw it again. Expansion, peak, contraction, trough, and back to expansion. So right now the economy is contracting, and then we expect, in this case, once we resolve COVID-19 issues, the pandemic, then we'll be back to expansion. But as we can see here, that you have recessions about every 7 to 11 years. And because of the dependency between Canada and the US, when the US is in a recession, we're in a recession. So we tend to see similar instability in the markets in our two countries. Here you can see the unemployment rates. So if we recall, let's go back. Remember, we had a recession in the 80s, early 90s, and then 2008. So notice that when the economy is contracting, the unemployment rate goes up. You can see that in the 80s and the 90s and 2008. We see that with COVID, contraction, less producing of goods and services, less jobs, higher unemployment rate. So that high unemployment rate, lower real GDP when we contract. When the economy is expanding, we have expansion. Real GDP, the amount of goods we produce, goes up, and the unemployment rate goes down. You can see here Canada and the US, so you can see their unemployment rate and ours. In macro, we'll talk about how we measure unemployment rates and some of the differences in the calculations so that you can compare Canada and the US. They aren't calculated exactly the same way, so we can't just compare the numbers straight to each other. I'm just going to get rid of this so we can see it here. So you'll notice that in this case, the US is sitting at about 15% unemployment. We're just under 14%. There is a 1% difference in the way that it's calculated. So if you want to compare the two, you have to make a 1% adjustment to the way we do the calculation so that you can compare them. But we'll talk more about that in macro. All right, so how do you deal with this instability in the market? We listed instability in the market as a market failure. The problem is we have high unemployment. If the economy is booming, we get inflation, high prices. How do we deal with this? Well, there are two solutions to instability in the market. The first is fiscal policy. The second is monetary policy. Fiscal policy is what governments do. This is taxation and spending. You can do it at a city level, a municipal level. You can do it at a provincial level. You can do it at a federal level. Spend and tax. Monetary policy is done by your central bank. We have the Bank of Canada, and they change the interest rates and the amount of money in circulation. So let's suppose that the economy, is contracting. So the economy is contracting, and you want to encourage growth and get people working and get people spending and getting the economy to make goods and services. So you want to reverse the contraction. You want real GDP to go up. Well, what could you do? Well, you could have the government spend more. They could create jobs, hire people. Puts cash in your pocket, means you'll go out to eat and you'll spend. And that means that other businesses will need to hire people to wait on you at the restaurant, to make that TV that you're buying. So the government could spend, and often it's infrastructure, hospitals, roads, creates jobs, puts money in people's pockets. The government could also lower taxes. That means you get to keep more of your own money, which means you will then spend it at the restaurant, going out to eat, you'll buy that TV. So government spending increasing, decreasing taxes. This is the way the government can prime the pump or stimulate the economy to get out of that contractionary period. Now, the challenge, of course, right now is that even if the government spends and lowers taxes, we're in a bit of a unique situation with COVID, that if the government spends and lowers taxes, people aren't necessarily going to go buy more stuff and businesses can't operate, right? There's a lot of restrictions on what businesses can operate and when, and limiting the number of people in the stores. So trying to stimulate out of this recession or contraction is more challenging than these other recessions. These other recessions, which we'll talk about in macro, have to do with things like changes in the cost. So in the 70s, we deal with high oil and gas prices, increasing cost of business. We can address that. Or a lack of consumer confidence. So we need to get people spending, get them jobs. That'll stimulate the economy. That's what we use our fiscal policy to deal with. COVID-19 is a bit more challenging because that government spending and taxation isn't necessarily going to get people out there buying things and making things. So the other solution we have is monetary policy. And monetary policy is the Bank of Canada changing interest rates. If we're trying to get out of a contractionary period, one thing the Bank of Canada can do is lower interest rates. That means it's cheaper to borrow, so you're more likely to buy a house and a car, and you're more likely to borrow money to go to school, get you spending, which means people need to make houses and cars and provide those services to you. So lowering interest rates gets people to spend and can get us out of a contraction. The other thing the Bank of Canada can do is they can print more money. If cash is easy to get a hold of, we're all flush, there's lots of people to borrow from, people are more likely to spend, businesses are more likely to expand. They get the economy boosted. So with COVID, it's a bit of a challenge because that fiscal policy isn't really helping us. Monetary policy, we can put more money in circulation and keep interest rates low so that it's easy to get cash and spend it, but you still need people and businesses to spend. And that's part of the challenge right now. And while even though there's these high unemployment rates and contractions in the economy, we're making less goods and services, this may not be an instability that we can help smooth out, unlike other recessions or depressions. Because really the point of monetary and fiscal policy is to lop off the top and the bottom of these business cycles so it's a little less unstable, so that we don't have the big peaks and the troughs. We smooth things out a bit. So monetary and fiscal policy are what we're going to talk about in macroeconomics. So we'll spend a lot more time on those topics then. What you need to know now is that instability in the market is a market failure. Fiscal policy and monetary policy are the solution to help smooth that out. Fiscal policy is government spending and taxes. Monetary policy is interest rates and changing the money supply.